Foot Locker reports in a couple of days and its shares have been battered with a consumer slowdown. Is it a value opportunity? That's what I want to talk about in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now it looks like Foot Locker will be reporting soon, but I want to show you what has recently happened with Foot Locker. But before I even do that, I just want to remind you guys that this was a name that we did speak about a year ago on this channel. It had subsequently run up. A couple people made some dollars on this name, but what actually happened a couple of years ago, and I'm going to dive into it right now, is that the stock actually dropped on the news of Nike going further into direct to consumer. So in other words, they were going to provide less merchandise to Foot Locker and sell more of it directly, and so that really hurt Foot Locker's share price. And of course you can see that it completely declined. And what ended up happening is at around this time, once the stock really started getting closer to that $20 per share level, a lot of us were asking, is Foot Locker sustainably impaired? I mean, retail is a very tough business. I like to see retailers with not a lot of debt or zero debt, preferably. Foot Locker has very little debt. They have around $400 million of long-term debt, but they have $300 million of cash. And so they can offset that. They can definitely offset it with free cash flow. And so it's not a material amount of debt, but I would like to see them in this environment to have zero debt, especially now as, they're starting to face a bit of a consumer slowdown. And so that's what's caused the share price to decline once again. So what happened was, just a reminder, Nike decided that they were going to go more towards direct to consumer. The stock declined, and then the stock actually came back up as Nike sort of backed off on that approach, and I'll dive into that a little bit more. And then of course the stock came right back down due to the consumer slowdown. And so I actually ended up buying it around here. We ran up a little bit, ended up getting rid of it, and now I'm kind of interested in it once again. And so let's dive into this further. And guys, I do have to remind you that it's never a recommendation to buy or sell a security on this channel. That's not the point. The point really is just to do good research. Always talk to your investment advisor before you buy any equities to make sure that they're right for you. But notice that, Foot Locker did tumble a couple of months ago. And the reason why is because they expected a weaker consumer. So they actually slashed their guidance. And, I would say, and I wrote it up here just for you guys to see, is that consumer slowdowns are not forever. So they don't really bother me. My question is, what is Foot Locker's plan to address the more secular challenges impacting retail so that they can succeed over the next 20 years? And what I'm really talking about here is, fewer and fewer people are frequenting malls. Your online presence is very important, and I believe that if you're going to succeed over the next 20 years as a retailer, you have to have a strong omni-channel presence. You can't just have an omni-channel presence. You have to have a strong omni-channel presence. And so, you need to be led by a company or have people in the company who understand how to build this stuff, or they've built it previously at other organizations. And so that's kind of what I want to see with retailers over the next, 10, 15, 20 years as they move towards this new world. And so, Foot Locker's CEO did say that their sales have softened meaningfully given through the tough macroeconomic backdrop, causing us to reduce our guidance for the year as we take more aggressive markdowns to both drive demand and manage inventory. And so, of course, lower margins are always going to worry investors. And so I'm not surprised that the share price declined and continues to decline. And although this is not a story anymore, I just wanted to point out that if you recall from last year, one of the reasons why the stock price declined materially was because, again, I mentioned it earlier in this video, is that Nike came out and said that they're going to provide Foot Locker with fewer shoes. Now, I still think that they're going to get fewer shoes, especially the most highly sought after shoes. However, Nike has softened its stance with respect to distribution in light of the discounting and margin compression in the current environment. And what you really saw, and you see it here in Barron's, is that Nike recently has rekindled its partnerships with retailers that it had previously stopped selling to, including Macy's and DSW. And, they've, what they said is that this wasn't a major shift away from its direct to consumer strategy, but a continued evolution of the strategy. And so to me, that sounds like a shift away from the strategy. And so, allow me to explain why this is a good idea. And the way I'll do that is by showing you guys the Nike model, and I'll show you guys the Foot Locker model. But, first, before we move into those models, I just want to show you how you can get to those models yourself and follow along if you'd like to. And so just a quick plug right now, you can actually get access to all of the models, all of my research at this lower tier of the Patreon. And if you want to join us at the higher tier, you can join us and actually speak to me directly every month. And so join over 200 people, or about 200 people, that have decided to support the Patreon. And so let's start with the Nike model first. So, as I mentioned in a previous video, it doesn't really look like Nike's direct to consumer strategy, that's this green highlighted thing right here, is more advantageous to the company, as their gross profit margins have remained the same. And so you can see it here, where their gross profit margin was around the 44 to 45% when their direct to consumer business was around 15% of overall sales. And then if you go right over to 2022, their gross profit margins are around the same area of 45%, whereas 40% of their sales are direct to consumer. And so, unless they're selling merchandise at lower price points in their company owned stores, I don't see how this is benefiting them or the consumer, and it just doesn't look like it's the case that they're selling merchandise cheaper at their own store. So I don't know where or what the strategy is in the direct-to-consumer space, if they're not making more money or if their consumers are not saving more money. And so, it makes a lot of sense from, in my opinion, that they continue a strong relationship with the distribution channels, which is the direction that they're looking to go now. And another reason why I believe Nike isn't really going anywhere for Foot Locker is because of Foot Locker's new CEO. And there's been a lot of speculation that their CEO and Nike CEO have been working together again since December. And, they did say, or Mary Dillon did say, who's the CEO of Foot Locker, said that they restarted joint planning and data and insight sharing with Nike. This could actually mean that Foot Locker will be Nike's next connected inventory partner. And recall, Nike is looking to capture more information on customer behavior and more closely monitor the products on the shelves at retail partners. So why not leverage their number one retail partner, which is Foot Locker? So another reason why I do believe that the partnership isn't going to be as strained as what we originally anticipated. But I don't think this is an issue anymore, but I just really wanted to hammer it home that it's not an issue. And so just jumping into Foot Locker's model, once again, you can get access to this when you get access to the whole tracker and all of the models that I do my research on. But I see a compelling opportunity where the risk reward is in the favor, if I could only spell favor, of the value investor. And note that there's, once again, no such thing as a sure thing. This absolutely could go much lower. I always have to state that because I can make mistakes in my research. So just take everything that I say on the channel with a grain of salt. But notice that I'm forecasting for 2023 that their revenue actually declines 12.5%. And so one thing that you guys are probably getting more and more used to as you watch my videos is I tend to be very conservative. I also tend to look for companies that are a little bit more predictable than some of the tech names that people tend to go into, like a Palantir or whatever. I generally don't go after those types of opportunities. And so, management has only forecasted sales to decline between 6 to 8%. I've been more conservative with my expected sales decline because none of us really know how bad Q4 can really be. And, going through the last couple of years, I think we sort of have to expect the unexpected and build that into our valuation models and then see if the company's still a value opportunity. And so, that really helped in many situations throughout the last couple of years. And so, what you're seeing is overall, this is a $2 stock trading at approximately $25 per share, which is reflecting an 8% equity yield. And so if this goes back to around that $4 per share level, that's a 20% equity yield. So it's a very compelling opportunity potentially if the company can rebound its earnings per share. So the question is, how can they rebound their earnings per share? Well, I think profitability increases in 3 ways. The first is by closing their underperforming stores, which you can see here they're absolutely focused on. So by 2026, they're going to have a net fewer 300 stores. And the point really is that they're just going to optimize, get rid of the stores that are underperforming, and focus less on malls. And so that's the second point. The second point that the second way that they're going to increase profitability is by growing their off-mall footprint, which could put them in locations that have a lower cost floor. So you can see here that right now 8% of their square footage is in the old formats, and then of course 20% is in the new formats. Actually, this is part of the first part, which is a store optimization. Here's the second part, where 35% of their stores currently are off mall, and they're going to be going to half or greater than half of their stores which are going to be off mall. And so I really believe that this would be a lower cost per square foot, and it's off mall locations, and that's kind of the direction where retail is going, where fewer and fewer people are visiting the malls, and more and more sort of like box stores, or sort of like plaza facilities or whatever, are being located closer to consumer homes, as people spread out further as well in this environment. And so you're starting to see that. I'm definitely seeing that in the GTA area as well. And so I just think this is another progression of retail, and I'm glad that Nike's focusing on that, or sorry, Foot Locker's focusing on that. But the other bigger point is that it's not just where your stores are located. It's not just getting them out of the malls, which is good, or getting them out of non-performing malls. But the other part of it is that successful retailers in this environment are going to be using an omni-channel approach. And that's exactly the direction that I see Foot Locker moving towards. And here's what I'm talking about. You can see that Mary Dillon, this Foot Locker CEO's experience with building Ulta Beauty's digital footprint should serve to be vital here, because they're going from 17% e-commerce to 25% e-commerce. And notice that they are trying to become the best-in-class omni-channel company. And then, just a little bit more of their strategy. Obviously, they're looking to grow sales, but not materially, right? It's the focus really is on profitability. That's really where they're focusing on. And so, and of course, fixing the channel. I mean, the sneaker market is a mature market. So if you're expecting it to surge in growth, I don't think you're going to see that. I think really what these turnaround opportunities are focused on is more just, can you increase the profitability of the company? And so, they want to expand this sneaker culture. And what they really mean by that is they want to move away from Nike. And so right now they're selling approximately 70% of the merchandise that they're selling is Nike. They're going to try to move to 60%, and 25% of that is going to be exclusive stuff. And then I already spoke to you guys about the off-mall stuff. And, this was very interesting. This has the footprints of what Mary Dillon did with Ulta, where they want to get to 70% or greater of their sales from loyalty programs. And, Foot Locker really hasn't done the best job in the world with loyalty programs. And so I want to see what Mary Dillon is able to generate or do in this situation. But again, you can see the real focus is on increasing that return on invested capital, increasing their EBIT margins. And so that's really it. The story is profitability. And so we're talking about the omni-channel approach and moving more towards digital sales. The question is, has Mary done this before? And this is where, we're really shining. This is an article from 2017. And notice that, back then when Mary Dillon became the CEO of Ulta Beauty, she actually increased the brand's digital presence, and she became an omni-channel focused retailer. So you can see here, she took a budget beauty retailer with a lagging digital presence and turned it into a media savvy brand. And so you can see it here. She actually rapidly grew Ulta's e-commerce presence, but also the physical shopping experience at Ulta retail stores was also crucial to her overall strategy. And so they expanded the overall footprint of Ulta Beauty both physically and digitally. And so she really focused on the omni-channel. And the only reason why I keep hitting on that is that a lot of retailers will say, hey, we're moving towards omni-channel, but they're not really. They're really just a brick and mortar retailer that has created a website. And so that's not what we're really looking for here. We're looking for someone who's very experienced in driving this home. And I do believe that Mary Dillon would be the person that I would be looking for to put in in the seat here to drive this forward. One of the biggest challenges that companies have is that you really just don't have the experience sitting in the seat for what you want to do going forward. And that's not really saying anything mean or disrespectful for the people in the seat currently. It just means that they just don't have the skill to take the brand or business forward. And for Foot Locker, I do believe that they do have the experience to take this company into the future. And so that's why I'm really excited. You can really see Mary Dillon's strategy being put into play here once again with Foot Locker that she did with Ulta Beauty. And so this is what I mean about that last statement. You can see that they're creating the loyalty program and they're going to be driving digital and loyalty type of sales. So you can really see the Ulta Beauty playbook being used with Foot Locker. And once again, I can't spell. The problem is that this thing doesn't have spell check. And so I got to be more careful here. But notice that the one area that a lot of people are not talking about, and if you blinked, you would miss it, is that they're also focused on Asia growth. And so they're going to be strategically licensing Asia. So I do believe that they continue with that. They didn't actually put that in the 2023 and beyond. So that might actually be something that they get rid of. I want to hear more about this from them, but I just don't see why you would stop strategically licensing Asia. And so let's see what happens there. And so thus far, you guys heard about optimizing their store footprint, creating a best-in-class digital channel. But the other thing is that they're also trying to drive cost savings. And let's talk more about that. Foot Locker currently has a $350 million cost savings program, and $200 million of that is expected to fall to the bottom line, and $150 million of that is expected to be used for CapEx to fuel their growth strategies. And so what does that $200 million mean as it falls to the bottom line? Well, the $200 million falling to the bottom line represents approximately $4 a share for the stock. So let's think about this for a second. If you are currently forecasting an 8% equity yield on a company that's going to be generating around $2 a stock in 2023, then going forward, if they're able to capture that $4 per share of savings, well, now it's that $2 plus that $4. Now you got $6 a share on a stock that's trading at $25 per share. So you see how that equity yield goes from 8% to well in the 20s, even 30s potentially, if they materialize these potential cost savings plus grow the business a little bit more. Now, when it comes to my valuation, I'm actually not building in a material amount of those cost savings. It's one of those let me see it before I believe it type of things. However, that just makes the model more conservative. And so even in that environment, I'm forecasting the company share price to be valued at somewhere around $50 per share, which is close to a double from what it's currently trading at. And so, you get an 8% equity yield while you're waiting. And, it does have a dividend, but you might run into a situation where they do cut the dividend. I think that if they wanted to cut the dividend, they would have done it in a previous quarter. So I actually don't think that the dividend is going to be cut. However, if things do get worse, the dividend could get cut. However, I still think that the company continues to be an 8% equity yielder in 2023. I mean, that's what they've guided to. I don't see any reason why it wouldn't move in that direction. However, we don't know what Q4 could look like in a potentially challenging environment. But, even last year we thought Q4 was going to be challenging, but it never ended up being as challenging as we thought it was going to be. And Q4 right now is looking to not be as challenging as we thought it was going to be as well. And so that would be good news for Foot Locker. And so let's see how that plays out. And just quickly, I wanted to look at the at the money covered call opportunity because the premiums are really high for Foot Locker. So here's the June 2025. You guys know that I like to look really long dated for these types of opportunities. And so you can see you can probably get around $6 and 25, 30 cents, maybe, who knows, for the at the money covered call. But what does that actually mean? And so before I get into the analysis of the covered call, I do have to warn you guys that this is just an example of how to view covered calls based on my opinion. This is not a recommendation to buy or sell options or the stock or anything. So always speak to your investment advisor before investing in individual securities, guys. But notice that this covered call analysis model is available for you guys free to download. And so you can change the inputs and see what the pricing works out for you. Now, I've updated the covered call model as well. So, here's where you have your inputs input. So I threw in Foot Locker. That's just today's date, the exchange, the exercise date. There's a strike price. And then the premium $6.30 is what we saw. There's the expected dividends over the next year. And so, what happens if you are assigned on the covered call? And what that means is that the stock is taken away from you because you got to buy the stock and then sell the covered call. Well, what ends up happening is you made the premium of $6.30. You actually received $2.94. It's just a math thing, but you just received approximately $2.94 of dividends, and you took a little bit of a loss because you would buy the stock at $25 and then you're assigned at it at 25, so you lost the 27 cents. So that's what that is. So your overall cash flow is around $9 per share, so it's around an annualized yield of 26%. But what happens if you are not assigned on the covered call and you hold on to your shares? Well, your cost basis just declines because you bought the stock for $25, you earned a premium of $6, and then you got some dividends as well. And so that actually reduced your cost basis significantly. That's actually not the valuation. I forgot to update that. I'll update that in the model that you guys download, but the valuation's around $50. So call it $50, 17 divided by 50. So 17 divided by 50. I'll just do that quickly right now, and you get around 34% of the valuation, not 9%. And so really, with an EPS run rate of $4 per share, $4 on 1737, you're looking at a greater than 20% equity yield. And so what you can see is that I really don't care what scenario plays out. I win no matter what, but ultimately I'd love to not get assigned on it because I'd love to have this low cost basis as the company continues to turn itself around. Now I might, the way I think about it is I might just own some shares and then use some shares with the covered call just to bring down the cost basis on that. But I kind of like the idea of just holding the shares in this particular situation because the equity yield is so high and it can go much higher. But I want to know what you guys think. Let me know in the comments below what you guys think about this opportunity and what you guys see going forward for retail in general. So I'll leave it there for you guys, and I'll see you later.